Hello, so earlier in the week I stumbled across this old TV ad from the 1980s for the Leeds Permanent Building Society with George Cole, he of Arthur Daly fame. And it was one of many ads he did for the Leeds as he bumbled from wide boy investment opportunity to wide boy investment opportunity. Have a little watch.
Well, I'm trying to make a bob or two, but it couldn't have been much slower. When Batterboy Bill from Muswell Hill said, "Psst, I've got a little goer. Meals on wheels." He said, "Barbecues are all the rage, what every garden needs. If you've got the loot, you can have the lot." I was laughing all the way to the Leeds. I wonder where he got them. See, I got an account called Liquid Gold, and the Leeds don't mess about. If you need some cash out sharpish, those girls will dish it out. Speedy Leeds, I call them. Then a message came from heaven, saying, "Son, don't catch a cold. Your money's doing well in there. That's why they call it gold." So it's Leeds 1, Bill 0. I said, "Sorry, Bill, if I bought this lot, I'll be completely off my trolley. You can keep your flaming barbecues, and the Leeds can keep my lolly."
Liquid Gold now pays up to 7.75% for bigger savers, so laugh all the way to the Leeds.
Now, the moral of that ad was that instead of getting involved in harebrained businesses, you're better off putting your money in the Liquid Leeds Gold account because it pays 7% interest. 7%! Then I found another one, and this one was for 9%.
I said, "It's got twin cam and turbocharged and reaches some airy speeds." He said, "I tell you what, I'll give you 1,200 sobs." I was laughing all the way to the Leeds. Well, I did bung him some free goggles. Well, they got this new account there by the name of Liquid Gold.
Yeah, I know that sounds like a lager.
But listen, son, and you'll be sold. I certainly was. You see, they pay you extra interest.
These were normal interest rates back then. Now, the Leeds Permanent Building Society was not so permanent as it turned out. It merged with the Halifax Building Society, lost its name, then the Halifax merged with the Bank of Scotland to form HBOS in 2001, and then following the global financial crisis, that became part of Lloyds. Today, the equivalent Halifax Everyday Saver account pays 0.01%. 0.01%. We don't have the option of 9% interest at the Leeds or anywhere else, and so we have to get involved in harebrained businesses, otherwise known as the stock market instead. And this dynamic explains so much. When you do a job, you expend energy, and for expending that energy, you are paid. The money you're paid is, in a way, a store of that energy, which you can then draw on at some later stage to buy some kind of good or service. For the system to work, it is vital that that monetary energy is retained. And when interest rates roughly reflected inflation, as in the 1980s, most of your energy was retained. There was an honesty to the system that has long since disappeared. Now, as globalization took hold in the 1990s, the incredible manufacturing powerhouse that was China was able to export its cheap goods aplenty, and we bought them aplenty. China's manufacturing costs were much cheaper than ours, and so China effectively exported lower prices. Meanwhile, in the West, in our measures of inflation, we focus on consumer prices, which, thanks to China and other factors, kept getting lower and lower. Look, inflation's low, said central bankers, as they ignored all the debt being created to buy houses, commercial property and financial assets, and so interest rates gradually got lower. Some could see that their money was losing its energy. House prices were going up at ridiculous rates. It was easy to borrow money, and so buy-to-let became a thing. You're better off keeping your money in bricks and mortar. Don't sell your flat as you move up the ladder to buy a house. Just keep the flat and borrow more. Instead of putting your money into the Leeds, you might have bought government bonds or gilts. These also paid you an interest rate that compensated you for the loss in purchasing power of your currency and helped retain that energy you had expended earning the money in the first place. But since 2008, that option no longer exists either. There is no way you'll hang on to your expended energy. And pension funds only buy bonds because they have to. I'm not joking. Regulations oblige them. We had the transformative invention of tracker funds and the exchange-traded fund, the ETF, and no longer did you have to take individual company risk or individual fund manager risk. You could just buy the stock market. And so this century, the stock market, especially to our American brothers and sisters, effectively became a savings vehicle that returned you somewhere between 5 and 20% a year, most years. In fact, the stock market became such an effective savings vehicle that many began using leverage, another word for debt, to buy more. And so the money supply increases. It was a bit like buy to let. And the stock market, especially in the US, continually rises to levels which for years have had value investors scratching their heads and wondering why they bother. The S&P 500 has become a savings vehicle. Now, I remember interviewing James Turk, who was the founder of Gold Money, back in 2006, and we talked at great length about the loss of purchasing power of fiat money. And James went so far as to write a book on the subject, The Coming Collapse of the Dollar, and how to profit from it. Buy gold, James would say, and at the time it was trading at around $500 an ounce. If we buy gold, I asked him, how do we know when to sell it? You're not going to sell it, James said. You're going to spend it. In other words, we were going to go back, one way or the other, somehow to using gold as money. Now, like Turk, Satoshi Nakamoto took a look at what was going on with the system of money, and he didn't like what he saw either. So he invented a new system of money called Bitcoin, and boy, did it catch on. Here was a new money to save, and boy, did it retain its energy. HODL has become its war cry. And today, Bitcoin is gold 2.0, they say, digital gold, immune to the pernicious forces of inflation. Its inflation rate is set in its code. And even large public companies are now using it as their savings vehicle. MicroStrategies has just raised another $1 billion to buy Bitcoin on top of the $1.5 billion it has already spent. Jack Dorsey's Square announced that it has purchased another $190 million worth earlier in the week. So we buy Bitcoin, we hodl. How do we know when to sell? You're not going to sell your Bitcoin, they say. You're going to spend it. I think we've heard that one before. No, but in this case, you really are. Bitcoin's most vocal proponents constantly lobby companies and individuals to start accepting Bitcoin. You'll be able to buy a Tesla with it. Some house vendors now accept Bitcoin. You can buy art in the form of NFTs. What about the capital gains tax implications of spending Bitcoin rather than selling it for fiat and then spending that? Do you have to pay capital gains tax then? I'm looking forward to watching that particular argument unfold. Life would be so much easier if governments protected the purchasing power of the currency they issue. But life isn't easy, and governments print. What is your chosen savings vehicle? Thanks very much for watching, folks. Please subscribe to my channel. And by the way, somebody is impersonating me in the comments, so please don't reply to any messages from someone pretending to be me. It isn't me. And I'll be back with another video very soon. Until then, goodbye.